JJ the CPA here. Hope you're doing well. Thanks for tuning in. On the employee retention tax credit, the three biggest misconceptions, the three biggest falsehoods, the three biggest errors that I'm seeing based on emails or discussion with others or CPAs or some of the seminars that I've done related to this is really the basis of this video here. The first is that if you're an essential business, you don't qualify for the employee retention tax credit. Nothing could be further from the truth. It is an absolute falsehood. I'm going to put a link to the ERTC FAQs and a specific link that shows you over and over and over how essential businesses still can qualify. The tax law indicates that if you have an interruption to commerce, travel, or group meetings, then you're going to qualify. Yes, there's a lot of things to consider with this, but essential businesses are not automatically knocked out, especially if you also have non-essential portions of your business. The second major error, falsehood, in my opinion, is those that think they only qualify if they were shut down and had a reduction in their gross receipts. It's an either or. If you have government interrupting your business, a partial or full shutdown, there's a lot of ways to qualify for that. You're then in the ballpark of qualifying for the employee retention tax credit. Or if your gross receipts are down, then you're in the ballpark for qualifying for the employee retention tax credit. Now in 2020, the gross receipts needed to be down at least 50% in any given quarter compared to 2019 correlating quarter. In 2021, it only applies to the first two quarters, but you only need to be down 20% in gross receipts compared to the correlating quarter, hear me on this one, in 2019 as well. So it's a either or, and make sure that you're then looking at these same FAQs that I'm also putting a link related to the gross receipts as well as then the shutdowns. The third one is a biggie. You might call it controversial, at least in the tax world, but I've really come to a conclusion today, March 1st, that owners and spouses that are 50 or over 50%, okay, this is very technical, over 50% ownership do not unequivocally qualify for the employee retention tax credit. You've got to read Code Section 51I1 as it is written. You almost have to relax your brain like I did, like really relax it and just read it for what it is, because FAQ number 59, which I'll put a link to related to ERTC, talks about related individuals. It doesn't indicate that the owners and the spouses are excluded, so you would think. But when you read it and you read the tax law that goes along with it, that is based on, I think you'll see what I'm seeing, which is this. When it's talking about a related individual, and when you're talking about, and it specifically says in FAQ 59 and specifically says in the tax law, both of which I'm giving you a link to, it says if the taxpayer is a corporation, it's then defining a related individual to the corporation, which is a more than 50% owner, which then includes the spouse, and then it also includes any of the relatives that are indicated. So I have a couple of videos talking about this. I did not conclude to you that I thought that the owners and spouses would qualify. I said, well, I guess I can see how some are making an argument. What I've contended in the beginning is until the IRS indicates unequivocally that we can take this, you shouldn't. I haven't taken that credit on any of my clients, on the owners or the spouses or their relatives that are working in the business. And it does seem as though if you start looking around, more and more tax experts are agreeing with this position because the law is plain. It says when the taxpayer is a corporation, a related individual is a more than 50% owner, and that always does include the spouse. So with that being said, those that don't agree, I really want you to double check yourself and really make sure that you're seeing it for how it's written. And we all know with the tax code, we all can have different opinions on this one. It would be great if the IRS would clarify, but there's been a group of CPAs that we've been analyzing this, and I think for all of us, a big light bulb went off when one of the major tax research providers came out and took the position that no, the owners don't qualify, the spouses don't qualify, and here's why. And it was like a V8 moment, bop, when you just read it for how it's written. All right, hey, those were the big three. Here's what I want you to know. I've put together a seminar. You can have instant access to it. It is packed full of info, so check out the link. Instant access, 2.5 hours with a PDF, PowerPoint that goes along with it, with extra videos, flow charts, examples, Excel spreadsheet. So check it out. It's only $97 and it's a ton of info. So if you have any interest in this, you're still considering if you qualify, check that out, as well as the other videos I've done on this. All right, hey, thanks for tuning in. I'd love it if you'd subscribe, and then don't you ever forget, you've never met a CPA quite like me.